This is the last video you need to watch about investing. Why is this the last video you need to watch? By the end, you won't just understand how success is achieved in the stock market. You'll also learn how to protect your wealth, grow it steadily, and avoid beginner mistakes. If you're a busy professional, especially someone like my doctor friends who can't find time to check their investments, then this is for you. I'm condensing 7 years of experience into life-changing principles you can apply immediately. At some point in this video, you may feel like you've heard these concepts before, but I urge you to stay with me. Why? Because the way these principles come together, along with the real-life examples and actionable strategies I'll share, will give you fresh perspectives and insights. Even if you know the basics, this video will help you refine your approach and uncover new ways to maximize your investment journey. Stick around, you won't regret it. The principles I'm about to share today are timeless. They've worked in past and will continue to work in future if followed consistently. These principles will act as guiding light in your investing journey, so pay close attention. Principle number 1, start early. Starting early is the single most powerful decision you can make in your investment journey. Time is not just a factor, it's the foundation of wealth creation. The earlier you start, the longer your money has to grow through the magic of compounding, turning small, consistent contributions into significant wealth over time. Remember, it's not about how much you invest, it's about how long you invest. The best time to start was yesterday, the next best time is today. Let's take real-life example. Rahul and Amit, who are of same age. But Rahul started investing rupees 10,000 per month at age 25, and Amit started investing rupees 10,000 per month at age of 35. If they decides to withdraw funds at 60 years of age considering 12% annual returns, it will look like this. Amit's 20,000 per month investment for 25 years gives rupees 3 crore 23 lakhs, 40,000 plus, while that of Rahul's 10,000 per month investment for 35 years gives 5 crore 23 lakhs plus. Despite investing less, Rahul ends up with more wealth because he started earlier and gave compounding more time to work its magic. Starting early is the single most important step you can take. Even small amounts can grow significantly with enough time. Principle number 2, maximize returns with minimal effort and low costs. We've all heard stories of people making big profits from individual stocks. Sounds exciting, right? But here's the reality. Stock picking is high risk and high maintenance. It requires constant research, attention, and the capacity to take risks. Remember the collapse of companies like Kingfisher Airlines? If you're a busy professional, stock picking might not suit your lifestyle. So what's the better option? Mutual funds? Let's see. Mutual funds might sound appealing, but they come with hidden costs, fees that eat into your returns over time. For example, let's look at Anjali. She invested rupees 5,000 per month in a mutual fund with an annual fee of 2%. Over 20 years, this fee reduced her returns by nearly 40% compared to a low-cost index fund. Just like returns, expenses also compound over time. Why pay for fund managers when you can achieve better results without the paying high fees? The truth is, many mutual funds simply track the market index. So why not skip the middleman and invest directly in a low-cost index fund? By doing so, you avoid unnecessary fees and still capture the market's long-term growth, putting more money back into your pocket where it belongs. Index funds are the ultimate set-it-and-forget-it option. They track the overall market, providing consistent returns in line with economic growth. Index funds are low-cost, passive investment vehicles that track the performance of a specific market index like the Nifty 50, or Nifty Next 50, or Nifty Small Cap. Instead of trying to beat the market, they aim to match its returns, offering simplicity, diversification, and consistency. With minimal fees and no need for active management, they're an efficient way to invest in the economy's long-term growth. For example, over the last decade, major indices have delivered annual returns of 10 to 12%. With a low expense ratio, index funds ensure most of your returns stay in your pocket. By choosing index funds, you minimize fees and maximize long-term growth. Principle number 3, diversification is essential. Diversification spreads your investments across different asset classes to manage risk. Imagine putting all your money into one stock or sector. If it crashes, your entire portfolio could sink. Inherently, investing in index funds comes with diversification as money gets diversified in whole index composition. But still, investing in a single category of index funds still carries risk. Large cap funds provide stability but limit growth, while small cap funds are volatile. Diversifying across multiple index fund categories balances risk and enhances growth potential. For example, during the 2008 financial crisis, investors who focused solely on small cap stocks lost up to 70% of their portfolio value. However, those with diversified portfolios, spanning large caps, mid caps, and small caps, experienced smaller losses and recovered faster. Optimal diversification strategy. A balanced portfolio might look like this: 30% in mid-cap index funds, growth potential. This strategy balances stability with growth while protecting your portfolio from market volatility. Principle number 4, be consistent. The power of small, steady steps. Dashrath Manji, famously known as the Mountain Man, is a symbol of determination and consistency. Over 22 years, armed with just a hammer and chisel, he single-handedly carved a path through a mountain to connect his village to essential services. His story teaches us the power of persistence, where small, consistent efforts day after day lead to extraordinary achievements. The same principle applies to investing. Even small, regular contributions can create significant wealth over time. Take the example of Kavita, a school teacher with a modest salary. At the age of 30, she started investing rupees 2,000 every month in a low-cost index fund, earning an average annual return of 10%. By the time she reached 60, her portfolio had grown to approximately 45 lakhs rupees, all from those consistent monthly investments. Kavita invested a total of 7,20,000 over 30 years, that is rupees 2,000 per month into 12 months for 30 years. The remaining 37 lakh rupees in her portfolio was the result of compounding returns. This illustrates the magic of consistency and starting early. Like Dashrath Manji's relentless effort to carve through a mountain, small, steady steps in investing can help you overcome financial obstacles and achieve your goals. No matter how small the amount, consistent investing creates momentum and leads to life-changing outcomes over time. Principle number 5, stick to one plan. Imagine digging shallow wells in multiple spots without committing to one. You'll never find water because the effort is scattered and lacks focus. Investing works the same way. Constantly changing strategies or chasing trends prevents you from reaping the full benefits of long-term growth, compounding, and a stable plan. Take Ramesh's story as an example. Initially, he switched his investment strategy every year. One year he focused on equity funds. The next year he moved to gold ETFs, and later he shifted to small-cap stocks, drawn by their high potential returns. This lack of consistency not only caused him stress, but also led to minimal growth in his portfolio. Every time he changed direction, he lost out on the opportunity to let his investments grow steadily over time. Frustrated by his lack of progress, Ramesh decided to simplify his approach. He adopted a consistent strategy, investing a fixed amount every month into a mix of large-cap and mid-cap index funds. This plan provided him with stability from large-cap funds and growth potential from mid-caps. Over the years, his disciplined and consistent investing allowed his portfolio to grow steadily, proving that patience and persistence pay off. The key lesson here is simple: commit to a strategy and give it time to bear fruit. Just like you need to dig deep in one spot to find water, sticking to a well-thought-out investment plan is essential to building long-term wealth. These are the principles I wish to share with you. Simple, timeless, and proven strategies that have the power to transform your financial future. By starting early, diversifying wisely, staying consistent, and sticking to a plan, you can build wealth steadily and avoid common pitfalls. Remember, investing is a marathon, not a sprint, and the journey you embark on today will shape the opportunities of tomorrow. Now that we've covered the key principles of investing, let's shift our focus to common mistakes that can derail your journey. Understanding these pitfalls is just as important as following the right strategies, as avoiding them can save you time, money, and unnecessary frustration. Common mistakes to avoid. This is a vast topic that deserves a separate video to cover in detail. However, to make this video comprehensive, we'll briefly touch upon the key points here to ensure you have a solid understanding of these common pitfalls and how to avoid them. Number 1, emotional biases. Avoid fear and greed. Stick to your long-term plan despite market ups and downs. Number 2, stock picking without expertise. Don't gamble on individual stocks. Index funds are safer and more consistent as an investment option. Number 3, lack of diversification. Always spread your investments across sectors to minimize risk. We have discussed that earlier, how index funds can be used to diversify. Number 4, Overreacting to news? Focus on long-term goals, not short-term noise. Bringing it all together. Today, we've covered the key principles of successful investing. Start early, choose index funds, diversify, stay consistent, and stick to one plan. These timeless strategies can help you achieve financial freedom. Now it's your turn. Start now, start small, and stay consistent. Set up automated monthly investments and trust the process. Remember, every investment is a step toward financial freedom and economic growth. If you found this video helpful, share it with friends and family. Let's build a community of smart investors and create a brighter financial future together. Thank you for watching. Until next time, happy investing.